There is a ghost in the machine of modern capitalism. It is a specter that haunts the boardrooms of the Fortune 500, the trading floors of Wall Street, and the anxious minds of ambitious individuals everywhere. It is the ghost of inevitable collapse, the quiet, ticking clock counting down to the moment the music stops. Most people, especially the most successful, spend their entire lives pretending this ghost does not exist. They build elaborate careers, intricate financial strategies, and entire identities on the comforting illusion that the party will last forever. They are the architects of their own magnificent fragile houses of cards, each one built closer to the sun, each one destined for the same gravitational fate. And then, the tide goes out. It always goes out. And in the stark, unforgiving light of a world stripped of its illusions, we discover who was truly a master builder and who was simply swimming naked, carried aloft by a current of collective delusion. In March of 2021, a man named Bill Hwang was, by all appearances, a master builder. He was the phantom king of Wall Street, a name whispered with a mixture of awe and confusion. His family office, Archegos Capital Management, was not just successful, it was a supernova. He had reportedly turned an initial stake of $200 million into a staggering $20 billion in less than a decade. He was the living embodiment of the dream sold to every aspiring financier, impossibly high returns, generated through sheer unadulterated genius. He moved markets. He made titans. His trades were so large, so audacious, that they created their own gravity, pulling the stocks he favored into a seemingly endless upward spiral. The world's most sophisticated investment banks, Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, lined up to do business with him, extending him billions upon billions of dollars in leverage, desperate for a piece of the magic. They saw his Midas touch, his phenomenal success, and they mistook it for invincibility. They saw a man clothed in the finest silks of market triumph, but they were wrong. He was swimming naked, and the tide was about to go out with a speed and violence that would vaporize his entire fortune and send shockwaves through the global financial system. In the space of 2 days, Bill Hwang's $20 billion empire ceased to exist. It didn't just shrink, it didn't have a bad quarter, it evaporated. $20 billion vanished into thin air. It was one of the single greatest losses of personal wealth in history, executed in the time it takes to watch a feature film. The banks that had funded his ascent were left holding the bag, suffering losses that climbed past $10 billion, wiping out years of profits in a single, catastrophic event. The postmortems were swift. Journalists and regulators scrambled to piece together the wreckage, and what they found was not a story of complex, esoteric fraud. It was a story of staggering, almost childishly simple recklessness. Archegos had used a financial instrument, called a total return swap, to build massive, concentrated positions in a handful of stocks. These swaps, provided by the banks, allowed Hwang to control vast amounts of stock without actually owning it, hiding the true scale of his bets from the public and even from the banks themselves, as no single institution knew the full extent of his exposure with others. He was leveraged to the hilt, perhaps 5, 6, or even 8 times his actual capital. As long as his chosen stocks went up, the system worked like a dream, amplifying his gains to a breathtaking degree. He looked like a genius. But when one of those stocks, Viacom CBS, announced a new share offering, its price dipped slightly. This small dip triggered a margin call from one of the banks. A margin call is the knock on the door from the ghost in the machine. It is the moment the lender asks for more collateral because the value of your leveraged bet has fallen. Hwang couldn't pay, and so the bank began to sell its holdings of Viacom CBS to cover its losses. This selling pushed the stock price down further, which triggered margin calls from the other banks, who then also began to sell in a mad, panicked scramble for the exits. It was a death spiral, a feedback loop of pure, unadulterated terror. The very leverage that had made him look like a god on the way up became the guillotine on the way down. The story of Bill Hwang is not an outlier. It is not a black swan event. It is a parable. It is the inevitable cyclical drama that plays out in every generation, in every market, in every field of human endeavor where ambition and capital collide. It is the story of long-term capital management, the hedge fund run by Nobel Prize-winning economists who built a model that they believed had abolished risk, only to have it blow up so spectacularly in 1998 that it threatened the stability of the entire financial world. It is the story of the bankers of 2008 who believed they had sliced and diced mortgage risk into oblivion, creating financial instruments so complex they no longer understood them, only to watch them unravel and bring the global economy to its knees. It is the story of every dot-com millionaire who believed in a new paradigm in 1999, every crypto evangelist who believed this time is different in 2021. They are all the same story. They are all swimmers in a rising tide. For decades, from a quiet office in Omaha, Nebraska, a man has been watching these tides come and go, not with the frantic energy of a participant, but with the calm, detached curiosity of a meteorologist studying the weather. Warren Buffett, the chairman of Berkshire Hathaway, has built a fortune exceeding $100 billion, not by predicting when the tide will come in, but by obsessing over what will be revealed when it goes out. His entire philosophy, his life's work, is built around a single, terrifyingly simple observation, an idea so profound it serves as the master algorithm for his entire cognitive operating system. He once wrote, "It's only when the tide goes out that you discover who's been swimming naked." This statement is the key. It is the Rosetta Stone for decoding the architecture of sustainable, generational wealth. It is dismissed by many as a piece of folksy, Midwestern wisdom, a simple aphorism. This is a catastrophic misinterpretation. It is not an aphorism. It is a diagnostic tool. It is a strategic mandate. It is a complete mental model for navigating a world saturated with illusion. It is a psychological operating system designed for one purpose: to achieve financial invincibility. This is not about being smart. Bill Hwang was smart. The Nobel laureates at LTCM were geniuses. The quants who designed mortgage-backed securities were brilliant. Being smart, it turns out, is not the antidote to swimming naked. In fact, it is often the cause. Intelligence, when combined with arrogance and a rising tide, is the most dangerous cocktail in the world. It gives you the confidence to swim further and further from shore, convinced of your own unsinkability, right up until the moment your feet can no longer touch the bottom. This documentary is a deconstruction of Buffett's tide goes out operating system. We will not merely admire the aphorism, we will dissect it. We will pull it apart, piece by piece, and reveal the intricate psychological and strategic machinery that makes it work. We will explore the great deception of the bull market, the cognitive biases that transform intelligent people into reckless gamblers. We will then reveal the three foundational pillars of Buffett's anti-ruin framework, the specific, actionable principles he uses to ensure that Berkshire Hathaway is not just a swimmer, but the owner of the entire beach, ready to sell towels and supplies to the shivering naked masses when the water recedes. Finally, we will provide you with the blueprint to install this operating system in your own life, to conduct a personal resilience audit on your finances, your career, and your decision-making, so that you can begin the process of building your own fortress of invincibility. Because the tide is always, always going to go out. The only question is what you will be wearing when it does. Welcome to the Great Deception. The first and most critical step to understanding Buffett's framework is to develop a deep, visceral understanding of the environment that creates naked swimmers in the first place. That environment is the bull market. A bull market is not merely a period of rising asset prices, it is a psychological phenomenon. It is a mass-produced reality distortion field. It is a factory for the manufacturing of geniuses. During a prolonged period of prosperity, the fundamental laws of financial gravity seem to be suspended. Risk appears to vanish. Prudence is mocked as cowardice. And the most reckless, the most leveraged, the most audacious speculators are hailed as visionaries. This isn't a moral failing. It is a predictable feature of human psychology, a set of cognitive biases that activate in our brains like dormant sleeper cells when we are exposed to a constant stream of positive reinforcement. To build a system of invincibility, you must first become an expert at identifying the architecture of this delusion in yourself and in others. The first and most powerful psychological force at play is what the psychologist and author Nassim Nicholas Taleb calls the narrative fallacy. The human brain is a story processor, not a logic engine. We are biologically hardwired to crave simple, coherent narratives to explain complex, random events. We see stock prices going up day after day, and our mind desperately seeks a reason. It cannot accept the uncomfortable truth that it might be a chaotic, random walk fueled by cheap money and mass psychology. Instead, it constructs a story. The internet is changing everything. This technology is a new paradigm. This CEO is a once-in-a-generation genius. These stories are immensely comforting. They give us a sense of understanding and control over a world that is fundamentally uncertain. The problem is that these stories are almost always written in hindsight. They are post-rationalizations of success. Bill Hwang wasn't a genius because he had a brilliant, repeatable system. He was labeled a genius because his concentrated, leveraged bets happened to work for a while. The story followed the outcome. This is a critical distinction. The narrative fallacy convinces us that the success was inevitable, a direct result of the protagonist's skill. This blinds us to the role of luck, timing, and, most importantly, hidden risk. In the late 1990s, the narrative was about the transformative power of the internet. Any company with a .com at the end of its name, regardless of its business model or profitability, was swept up in the story. To question the narrative, to ask for something as mundane as profits, was to be a Luddite, a fossil, someone who just didn't get it. The story was so powerful that it overrode basic financial logic. Investors weren't buying businesses, they were buying a piece of the narrative. Warren Buffett, who famously sat out the dot-com bubble, was ridiculed. He was a relic of an old economy. A brilliant profile in Barron's in 1999, titled, "What's Wrong, Warren?" summed up the sentiment. The narrative was that Buffett had lost his touch. The reality was that he was one of the few people who refused to be seduced by the story. He understood that narratives are the siren songs of financial ruin. They lure you onto the rocks of speculation by promising a beautiful, easy journey. When the tide of the dot-com bubble went out, the stories evaporated, and all that was left were the balance sheets, the cash flows, and the brutal, unforgiving math. The narrative fallacy is the soil in which the illusion of genius grows. The second psychological mechanism that fuels the deception is a potent combination of social proof and herding. Humans are social creatures. Our survival for millennia depended on our ability to conform to the tribe. When we see everyone around us doing something and becoming wealthy and successful as a result, the pressure to join in is almost unbearable. This isn't just a matter of greed, it's a deep-seated fear of being left behind, of being the fool who missed the party. In a bull market, this instinct runs rampant. Your neighbor, who knows nothing about finance, is suddenly a stock-picking guru because he bought a tech stock that tripled. Your colleague is flipping houses and making a fortune. Everyone seems to be effortlessly minting money. The signal your brain receives is deafening. They are all right, and you are wrong. This is the engine of every speculative bubble in history. From the Dutch tulip mania in the 1630s, where people sold their homes to buy a single tulip bulb, to the housing bubble of the mid-2000s, where the shared belief that housing prices only go up led to a nationwide frenzy of reckless borrowing and lending. The logic is always the same. If everyone else is doing it, it must be safe. In fact, the opposite is true. The more people who are participating in a particular trade or investment, the more dangerous it becomes. The late-arriving participants are the dumb money, providing the liquidity for the early smart money to exit. By the time an investment strategy is featured on the cover of a magazine and is the topic of conversation at every dinner party, the tide is likely about to turn. The social proof becomes a trap. It creates a sense of safety in numbers, while in reality, the crowd is stampeding towards a cliff. Leverage becomes normalized through this process. In the early stages of a boom, using debt to finance investments is seen as risky. But as the boom continues, and the leveraged players post the most spectacular returns, the perception shifts. Leverage is no longer seen as risk. It's seen as a tool of the bold, the intelligent, the aggressive. The banks, fueled by their own herding instincts and the fear of losing business to competitors, relax their lending standards. They offer more and more debt to people like Bill Hwang. The entire system begins to believe its own press. Prudence is punished, and recklessness is rewarded. This creates a feedback loop. Rising prices justify the leverage, and the leverage fuels higher prices. Everyone feels smart. Everyone feels rich. Everyone is swimming naked together, convinced that the sheer size of the crowd provides a form of collective clothing. The third cognitive bias that completes this toxic cocktail is extrapolation bias. Our brains are prediction machines, but they are lazy. The simplest way to predict the future is to assume it will be a linear continuation of the recent past. If stocks have gone up for the last 10 years, our brain's default setting is to assume they will go up for the next 10. We are notoriously bad at pricing in a paradigm shift or a catastrophic break in the trend. This is an evolutionary hangover. For most of human history, the world was relatively stable. The seasons changed, but the fundamental rules of survival remained the same. This cognitive shortcut worked. In the complex, non-linear world of financial markets, it is a recipe for disaster. Bull markets are particularly effective at training our brains to extrapolate. Every small dip is bought, reinforcing the belief that prices only move in one direction. The memory of the last crash fades, replaced by the immediate reality of easy money. This creates a profound sense of complacency. Investors stop thinking about what could go wrong. They stop stress testing their assumptions. Their risk models become based on the benign data of the recent past, completely ignoring the possibility of a violent reversion to the mean. The managers at long-term capital management fell into this trap. Their models were built on historical data that suggested the kind of market dislocation they experienced in 1998 was a statistical impossibility, an event that should happen only once in the history of the universe. They extrapolated from a period of relative market calm and assumed it was a permanent state of affairs. They were swimming naked in the placid waters of flawed statistical assumptions when the Russian debt default of 1998 occurred, an event their models had not and could not predict. The tide went out, and their risk-free arbitrage strategies were exposed as massively leveraged, one-way bets on the continuation of a stable world. They were wiped out. These three forces, the narrative fallacy, social proof, and extrapolation bias, are the unholy trinity of the bull market. They work in concert to create a psychological bubble that is every bit as real and far more dangerous than the financial bubble in asset prices. They create an environment where the most foolish actions are perceived as the most brilliant strategies, and they set the stage for the inevitable reckoning. To make this concrete, let's define the archetypes of the naked swimmers that this environment produces. Understanding these archetypes allows you to spot the patterns not just in the market but in your own industry, your own company, and even in yourself. The first and most obvious archetype is the leveraged genius. This is Bill Hwang. This is the individual or institution that uses massive amounts of borrowed money to amplify their returns. In a rising market, their results are spectacular. They are celebrated on the front pages of financial publications. They are the hot hands, the new kings. Their use of leverage is seen as a sign of their conviction and their brilliance. They are not just participating in the market's rise, they are supercharging it. The psychological trap for the leveraged genius is that they begin to believe their own narrative. They mistake the returns generated by leverage for returns generated by their own skill. Their ego inflates with their balance sheet. They take on more and more risk, because in their minds, they have conquered it. The problem, as Buffett has stated, is that leverage is a one-way street. If you're smart, you don't need it, he says, and if you're dumb, you shouldn't be using it. Leverage has no upside that isn't matched by a catastrophic, ruinous downside. A 50% loss requires a 100% gain just to get back to even. A 100% loss, which leverage makes possible, means you are out of the game forever. The leverage genius is playing a game of Russian roulette. They may win round after round, making them look bold and brilliant, but the game only has one ultimate conclusion. The tide goes out when the source of credit dries up, or when the underlying asset takes a sudden downturn. Their genius is revealed to have been nothing more than a simple bet on a rising line, amplified by borrowed money. The second archetype is the complexity charlatan. This is long-term capital management. This is the individual or institution that uses opaque, esoteric, and impossibly complex strategies. They wrap their activities in the language of advanced mathematics, quantum physics, and proprietary algorithms. They project an aura of intellectual superiority that intimidates outsiders, and even their own investors, into not asking the hard questions. Their complexity serves as a form of intellectual moat, protecting them from scrutiny. The appeal of the complexity charlatan is immense, especially to intelligent and sophisticated people. It caters to the belief that the secrets of the market can be unlocked with sufficient brainpower and computational force. Investing with them makes one feel like part of an elite club, privy to secrets the average person cannot comprehend. The nakedness of the complexity charlatan is hidden beneath layers of jargon and formulas. Their risk is not visible on the surface. It is buried deep within their models, in the assumptions they have made about correlations and volatility. They believe they have diversified their risks, but often, in a crisis, all correlations go to one. All the seemingly independent bets they have made suddenly move in the same direction, against them. The tide goes out on the complexity charlatan when a real-world event occurs that was not in their dataset, a so-called black swan. Their elegant models, built for a world of predictable bell curves, are shattered by the jagged edges of reality. Their complexity is revealed not as a sign of genius, but as a mechanism for hiding a simple, fragile bet that the world would remain orderly. The third archetype is the operational mimic. This is perhaps the most insidious and common form of naked swimming, because it happens inside established, seemingly conservative companies. The operational mimic is the company that, caught up in the frenzy of a boom, begins to copy the surface-level tactics of its high-flying competitors without understanding the underlying risks. It is the regional bank in 2006 that saw its peers making fortunes in the subprime mortgage market and decided it needed to get in on the action, abandoning its decades-old conservative lending practices. It is the industrial conglomerate that, seeing tech companies trade at insane multiples, starts spending billions on frivolous .com acquisitions to appear more innovative. The operational mimic is driven by institutional peer pressure, the fear of being left behind, and the demands of a stock market that is rewarding growth at any cost. The CEO sees the stock price of his rival soaring and feels immense pressure from his board and shareholders to do something. This leads to a phenomenon Buffett's partner Charlie Munger calls fibezzlement, the functional equivalent of embezzlement, where a company's managers use shareholder money to pursue foolish, ego-driven projects and acquisitions that have little long-term value but create the short-term illusion of progress. The nakedness of the operational mimic is in its balance sheet and its business model. It has taken on debt to fund a foolish acquisition. It has diluted its culture by chasing a fad. It has abandoned its core competencies, its economic moat, in pursuit of a fleeting narrative. The tide goes out for the operational mimic when the inevitable recession hits. The faddish new division hemorrhages cash. The debt taken on for the overpriced acquisition becomes an anchor around the company's neck. The core business, neglected during the boom, is no longer strong enough to carry the dead weight. The company that looked dynamic and aggressive during the good times is revealed to be fragile, unfocused, and poorly managed. Understanding these archetypes, the leveraged genius, the complexity charlatan, and the operational mimic, is the first step toward diagnosing the invisible risks that saturate a bull market. These are the patterns that repeat again and again with different names and in different industries, but with the same tragic ending. And it is the deep, cellular understanding of this tragic cycle that forms the foundation of Warren Buffett's entire system. He has spent a lifetime observing these swimmers, not to emulate them, but to learn from their inevitable, predictable drownings. This understanding leads us out of the world of delusion and into the world of resilience. It brings us to the core of our subject, the deconstruction of the anti-ruin operating system that Buffett has spent 70 years perfecting. It is an operating system built not on the prediction of rain, but on the building of an ark. This system is not a single idea, but a trinity of interlocking principles, a cognitive fortress with three great walls. The first pillar, the very foundation upon which the other two are built, is a profound and counterintuitive mental discipline, the inversion mandate. The average mind, when faced with a problem or an opportunity, instinctively asks, "How can I achieve success?" The Buffett mind, the mind conditioned for invincibility, asks a radically different question. It asks, "How could I get absolutely catastrophically destroyed here?" This is the practice of inversion, a mental model championed by the ancient Stoics and perfected by Buffett's partner Charlie Munger. Instead of thinking forward toward a desired outcome, you start at the end, with total failure, and work backward to identify all the potential paths that could lead to that disastrous result. Then, you simply avoid those paths. As the mathematician Carl Jacobi famously said, "Invert, always invert." It's a simple idea with earth-shattering implications. By focusing on the avoidance of stupidity rather than the pursuit of brilliance, you dramatically improve your odds over the long term. Most people are so focused on winning the game that they don't see the open manholes on the field. Buffett and Munger are obsessed with mapping the manholes. For Buffett, this isn't a casual thought experiment. It is the rigorous, non-negotiable first step of any analysis. Before he even considers the potential upside of an investment, he engages in what psychologists now call a quote, pre-mortem. A post-mortem is what a doctor does after a patient has died to figure out what went wrong. A pre-mortem is the act of imagining in vivid detail that the patient, the investment, the project, the career move has already died a horrible death, and then asking, what killed it? This mental exercise forces the brain out of its natural optimistic state. It bypasses the confirmation bias, our tendency to seek out information that confirms our pre-existing beliefs. When you are excited about an investment, your brain will naturally highlight all the reasons it's a brilliant idea. The pre-mortem forces you to do the opposite. It makes you the devil's advocate for your own best ideas. What could kill this company? A change in technology? A new competitor? A shift in consumer behavior? A reliance on a single supplier? A key executive leaving? And the most important question of all, is there any leverage in the system that could turn a small problem into a fatal one? Let's take a look at a real-world application. Imagine it is 2005. The housing market is white-hot. A bank like Washington Mutual is minting money by originating and selling subprime mortgages. A forward-thinking analyst, focused on success, would look at the soaring profits, the rising stock price, and the narrative of making the American dream of homeownership accessible to all. They would conclude it's a brilliant investment. A Buffett-style analyst, applying the inversion mandate, would start with a different premise. They would say, let's assume it is 2010, and Washington Mutual has gone bankrupt. It is a smoking crater. What could have possibly happened? This question immediately changes the entire frame of reference. The analyst would now be forced to consider scenarios that the optimistic, forward-looking view ignores. What if housing prices stop going up? What if they fall by 20%? What happens to these subprime borrowers who have little to no equity in their homes? If they lose their jobs in a recession, what happens to the value of the mortgage-backed securities on the bank's books? How much leverage is the bank using? A quick look at the balance sheet would reveal that the bank is leveraged 30-1, meaning a mere 3.3% decline in the value of its assets would wipe out its entire equity base. Suddenly, the picture is no longer of a thriving, innovative financial institution. It is a picture of an institution that is swimming naked, completely exposed to a single point of failure, the continuation of an unprecedented housing bubble. By starting with the assumption of ruin, the analyst uncovers a fatal fragility that was completely invisible from the forward-looking perspective. This is the power of inversion. It is a cognitive tool for seeing the invisible. This process is not just for analyzing other companies. It is something Buffett has had to apply to his own mistakes. His single worst deal, by his own admission, was the acquisition of Dexter Shoe Company in 1993. Buffett paid $433 million for Dexter, and he made the payment not in cash, but in Berkshire Hathaway stock. At the time, Dexter was a wonderful American business, manufacturing sturdy, high-quality shoes in its main factories. It had a long history of profitability. From a forward-looking perspective, it seemed like a classic Buffett acquisition. But Buffett failed to properly invert. He failed to ask the killer pre-mortem question: what could destroy the fundamental economics of this entire industry? The answer, which became painfully obvious just a few years later, was foreign competition. Low-cost manufacturers in Asia began to flood the market with shoes that were of acceptable quality at a fraction of the price. The durable competitive advantage, the moat, that Dexter had enjoyed for decades was not just shrinking, it was being vaporized. The tide of globalization was going out on American shoe manufacturing, and Dexter was left swimming naked. The company's value collapsed to zero. But the mistake was far worse than just losing $433 million. Because Buffett had paid with Berkshire stock, the true cost of the error compounded over time. The shares he gave to the owners of Dexter would, by 2014, be worth over $5.7 billion. It was a multi-billion-dollar mistake, born from a failure to imagine a disastrous future. This experience seared the importance of the inversion mandate into Buffett's brain. It taught him that the most dangerous risks are not the ones you can see in the rearview mirror of a company's financial history, but the ones that lie ahead, threatening the very foundations of its business model. The inversion mandate is the strategic brain of the anti-ruin operating system. It sets the direction. But for it to function, it needs a powerful tactical partner, a non-negotiable rule of engagement that governs all actions. This brings us to the second pillar of the fortress, and perhaps the most viscerally held of all Buffett's principles, the scorn for leverage. If inversion is the mind of the system, the scorn for leverage is its heart. It is an almost religious conviction, a deep-seated, gut-level revulsion against the use of borrowed money. To understand Buffett, you must understand that he views leverage not as a financial tool, but as a moral failing. It is the cardinal sin in his financial universe. He is famous for his 3 L's that can ruin a person: liquor, ladies, and leverage. He notes that the first 2 are enjoyable, but leverage is the only one that can wipe you out when you are both smart and sober. This is not just a personal quirk. It is a calculated, logical position based on a deep understanding of mathematics and human psychology. The mathematical case against leverage is brutally simple. It rests on what we previously called the asymmetry of ruin. Let's say you have $100. If you lose 50%, you are down to $50. To get back to your original $100, you now need to achieve a 100% return on your remaining capital. The math gets exponentially harder the more you lose. A 90% loss requires a 900% gain to recover. Leverage dramatically increases the probability of suffering these large, difficult-to-recover-from losses. Imagine you have $100 of your own capital and you borrow another $100, giving you $200 to invest. This is 2-to-1 leverage. If your investment goes up by 25% to $250, you pay back the $100 you borrowed and are left with $150. Your return on your original $100 is 50%. You look like a genius. But what if the investment goes down by 25%? Your $200 is now worth $150. You still owe the bank $100. You are left with just $50. A 25% decline in the asset has resulted in a 50% loss of your personal capital. What if the investment goes down by 50%? Your $200 is now worth $100. You pay back the bank and you are left with zero. A 50% decline has resulted in a 100% loss. You are wiped out. You are out of the game. For Buffett, being forced out of the game is the only outcome that is truly unacceptable. His first rule of investing is never lose money. His second rule is never forget rule number 1. This isn't about avoiding any and all losses. It's about avoiding the permanent loss of capital, the kind of catastrophic loss from which there is no recovery. Leverage is the single most effective tool ever invented for causing the permanent loss of capital. This is why Buffett is so adamant about it. He has said he would not be comfortable even if he had a 99% chance of success with a leveraged bet and only a 1% chance of ruin. If you and I are playing Russian roulette and there's a gun with 1,000,000 chambers in it, and there's one bullet in one of them, and you said pull it once and I'll give you $1,000,000, I wouldn't do it. You can have a whole lot of upside, but it doesn't make any sense if there is any chance of a downside that's ruin. But the mathematical argument is only half the story. The psychological case against leverage is even more compelling. Why do smart people, who understand the math, still use leverage? Buffett identifies 3 primary drivers: ego, impatience, and envy. Ego is the belief that you are smarter than the market, that you can handle the risk better than anyone else. The initial success that leverage provides feeds this ego, creating a dangerous feedback loop. Impatience is the desire to get rich quickly. Compounding, Buffett's preferred method of wealth creation, is a slow, patient process. It requires decades to work its magic. Leverage offers a shortcut, a seductive promise of compressing a lifetime of returns into a few years. Envy is the most powerful driver of all. As Charlie Munger has said, it is not greed that drives the world, but envy. Watching your neighbor get rich using leverage is a form of psychological torture. It makes your own, more prudent progress feel inadequate. The pressure to keep up with the Joneses, or in the case of Wall Street, to keep up with the Huangs, is immense. It forces people to abandon their better judgment and take on risks they know are foolish. Buffett has systematically engineered Berkshire Hathaway to be the ultimate anti-leverage machine. Its very structure is a testament to his scorn for conventional debt. The core of Berkshire is a collection of massive insurance companies: Geico, National Indemnity, and others. An insurance company has a unique financial characteristic. It collects premiums from customers up front and pays out claims later. In the interim, it holds this pool of money, known as float. This float is, in effect, borrowed money, but it is the best kind of borrowed money imaginable. It is borrowed money with no interest rate. In fact, if the insurance operations are profitable, the cost of float is negative. It is borrowed money with no due date. And it is borrowed money with no covenants, meaning no one can call it back during a panic. Buffett can then invest this float for the benefit of Berkshire's shareholders. As of 2021, Berkshire's float exceeded $147 billion. This is the secret engine of Berkshire's growth. It allows Buffett to have the benefits of leverage, a large pool of capital to invest, without any of the terrifying risks of conventional debt. While other companies are dependent on the kindness of bankers, Buffett is dependent only on his ability to run his insurance businesses at a profit. This structure is not just a defensive masterpiece. it's an offensive weapon. Because Berkshire is not leveraged and sits on a mountain of cash and float, it becomes the lender and buyer of last resort when the tide goes out. During the 2008 financial crisis, when the entire financial system was on the brink of collapse and credit markets were frozen solid, who did the titans of Wall Street turn to? They turned to Warren Buffett. He invested billions in Goldman Sachs and Bank of America on terms so favorable they were essentially a gift. Why? Because he was the only one with cash. Everyone else was swimming naked, desperate for a lifeline. Buffett was standing on the shore, holding a very expensive towel. His scorn for leverage had transformed a crisis into the single greatest investment opportunity of his lifetime. But Buffett's concept of leverage extends far beyond the balance sheet. He encourages us to see the hidden forms of leverage that can exist in a business, a career, or a life. A business with high fixed costs, for example, has high operational leverage. A small drop in sales can cause a massive drop in profits. A career built on a single, highly specialized skill tied to a rapidly changing industry is a form of career leverage. You may be highly paid during the boom, but you are completely exposed if that industry is disrupted. A life with a high burn rate, expensive mortgages, car payments, and lifestyle costs is a form of personal leverage. It reduces your resilience, your ability to withstand a job loss or a financial setback. The second pillar, the scorn for leverage, is a mandate for sobriety in a world drunk on debt and risk. It is the tactical discipline that ensures you will always have the capital and the psychological fortitude to stay in the game. But where do you deploy that capital? How do you choose where to play? That brings us to the third and final pillar of the fortress, the intellectual backstop that protects the entire system from the unknown. This is the principle of the circle of certainty. Many will recognize this as a reframing of Buffett's famous circle of competence idea. The traditional interpretation of this idea is simple: stick to what you know. If you are an expert in the railroad industry, invest in railroads. If you don't understand biotechnology, stay away from it. This is true, but it misses the deeper, more profound risk management dimension of the concept. Buffett's goal is not just to invest within his circle of competence. It is to define that circle in such a way that it only includes businesses and industries where the risks are knowable and analyzable. The true purpose of the circle is to avoid areas where hidden, unpredictable, and potentially catastrophic risks are most likely to exist. It is a tool for intellectual sobriety. Think of the business world as a vast, unexplored continent. Some parts of this continent are well mapped, stable, and have been inhabited for centuries. Think of businesses that provide basic, unchanging human needs: food, beverages, insurance, housing. Other parts of the continent are frontiers, constantly shifting, with unknown creatures and volatile geology. This is the world of cutting-edge technology, complex financial innovation, and industries undergoing rapid disruption. Buffett is not a Luddite. He is not afraid of technology. He is, however, terrified of unpredictable environments. His decision to avoid most technology stocks for decades, especially during the dot-com bubble, was not because he didn't believe in the internet. It was because he could not, with any degree of certainty, predict what the competitive landscape of the internet would look like in 10 or 20 years. He could not identify the durable competitive advantages, the moats, that would protect a winner from a swarm of new, innovative competitors. The industry was simply too dynamic, too chaotic. In such an environment, the tide can go out with breathtaking speed. Today's market leader can be tomorrow's footnote. For every Google, there was an Alta Vista, an Excite, a Lycos. For every Amazon, there was a Webvan, a Pets.com, a Boo.com. From the outside, during the boom, it was impossible to tell which was which. Investing in that environment was not investing, it was speculating. It was a bet on being able to predict the future in a fundamentally unpredictable system. Buffett's circle of certainty, therefore, is a disciplined refusal to play games he cannot win. He seeks out simple, understandable businesses. This is not because he is simple-minded. It is because simplicity allows for clarity of risk. When he analyzes Coca-Cola, he can understand the business in 5 minutes. People around the world like to drink sweet, cold, brown liquid. The company has a powerful brand, a global distribution network, and a secret formula. What are the major risks? A shift in consumer tastes away from sugary drinks. This is a real risk, but it is a slow-moving, analyzable one. It is not the kind of risk that will bankrupt the company overnight. When he analyzes a complex derivative structure or a new biotech drug, the risks are of a different nature entirely. They are hidden in fine print, in scientific data he cannot interpret, in regulatory decisions he cannot predict. He cannot apply his pre-mortem analysis effectively because he doesn't even know what questions to ask. The circle of certainty is his filter to exclude these unknowable risks from his portfolio and from his mind. The case study for this pillar is, of course, his famous performance during the dot-com bust of 2000 to 2002. As the Nasdaq soared in the late 1990s, Berkshire Hathaway's stock dramatically underperformed. The press, the market, and even some of his own shareholders wrote him off as a relic. He was a dinosaur who didn't understand the new economy. The pressure to abandon his principles, to join the party, was immense. But Buffett held firm to his circle of certainty. He admitted his ignorance. He said, "I don't know how to value these companies." This admission of "I don't know" is one of the most powerful phrases in an investor's vocabulary. It is the hallmark of intellectual honesty and the ultimate defense against being swept up in a speculative mania. When the bubble burst and the Nasdaq lost nearly 80% of its value, wiping out trillions of dollars in speculative wealth, Berkshire's value held firm and then began to climb. The tide had gone out, and Buffett, clothed in the sturdy armor of his simple, profitable, old economy businesses, was revealed to be the wisest man in the room. His refusal to play in a game he didn't understand was not a sign of weakness, but of ultimate strength. These 3 pillars, the inversion mandate, the scorn for leverage, and the circle of certainty, form the impenetrable cognitive fortress that Buffett has built over a lifetime. They are not separate ideas, but a single, integrated system. The inversion mandate forces you to look for the fatal flaw. The scorn for leverage teaches you that the most common fatal flaw is debt. And the circle of certainty guides you to operate only in areas simple enough that you can be confident you have identified all the potential flaws. This system is what allows him to operate with a degree of rationality and patience that seems almost superhuman. It is the source of his ability to be greedy when others are fearful, and fearful when others are greedy. It is the blueprint for financial invincibility. Now the critical question remains: how can you, an ambitious individual living in this same world of illusion and risk, apply this blueprint to your own life? This is not a system reserved for billionaires. It is a set of mental tools, a way of thinking that can be installed by anyone willing to do the work. The process of installation begins with a rigorous and brutally honest self-assessment, what we will call the personal resilience audit. This audit has 3 components: a financial audit, a career audit, and a decision-making audit. The first step is the financial audit. You must become the Warren Buffett of your own personal balance sheet. This means looking at your financial life not through the lens of income or lifestyle, but through the lens of fragility. The first and most important question is, where am I swimming naked? Where am I exposed to the tide going out? The primary area to examine is, of course, leverage. List every single debt you have: mortgage, student loans, car loans, credit card debt, personal loans, and especially any margin loans in your investment accounts. For each debt, ask yourself the hard questions. Is this debt productive, e.g., a sensible mortgage on a home, a student loan that led to a high-paying career? Or is it consumptive, e.g., credit card debt for vacations and luxuries? What is the interest rate? Is it fixed or variable? A variable rate loan is a form of hidden risk, exposing you to a sudden increase in payments if interest rates rise. Then, perform a personal stress test. What happens to my ability to service this debt if my income is cut by 30%? By 50%? if I lose my job? How many months of living expenses do I have in a liquid emergency fund? Buffett would not operate Berkshire without a massive cash cushion, at least $20 billion at all times. What is your equivalent? If your emergency fund is less than 6 months of essential expenses, you are swimming naked. You have no buffer against the inevitable surprises of life. Next, examine your investments. Are you using margin? If so, you are playing Bill Hwang's game, even if on a smaller scale. Are your investments concentrated in a single high-flying stock or sector? This is a form of concentration risk, a hidden leverage. Do you own complex financial products you don't fully understand? These are black boxes that could contain nasty surprises. The goal of the financial audit is to identify and systematically reduce these points of fragility. It may mean aggressively paying down high-interest debt, building a larger cash reserve, simplifying your investment portfolio, and vowing to never, ever use margin debt. It is the process of putting on your financial swimsuit. The second phase is the career audit. This is where you apply Buffett's thinking to your single most important asset, your earning power. Too many people have careers that are highly leveraged to a single employer, a single industry, or a single skill set. They are swimming naked in the currents of the modern economy. Ask yourself, is my entire professional identity and income tied to a company or industry whose moat is shrinking? Am I the highly skilled shoemaker at Dexter Shoe Company in 1993? Am I the well-paid newspaper journalist in 2005? Am I the expert in a software language that is about to be made obsolete? This requires brutal honesty. It requires you to apply the inversion mandate to your own professional life. Imagine it is 5 years from now and your skills are no longer in demand. What happened? Was it artificial intelligence? Was it globalization? Was it a shift in consumer behavior? By running this pre-mortem, you can identify your biggest vulnerabilities. The antidote to career fragility is to build a portfolio of skills and relationships. It means constantly learning, developing competencies outside of your core job description. It means building a strong professional network that is not confined to your current company. It means developing what Cal Newport calls career capital, rare and valuable skills that are transferable across industries. It might mean starting a small side business to diversify your income streams. It is the process of building your own personal economic moat, one that is not dependent on the fortunes of a single employer. The third and final phase is the decision-making audit. This is the most psychological part of the process. It requires you to become an observer of your own mind, to identify the biases and emotional triggers that lead you to make fragile, short-sighted decisions. For 1 week, keep a decision journal. Write down every significant decision you make, whether financial, professional, or personal. Next to each decision, write down the reason you made it. What was your emotional state? Were you feeling fearful, greedy, envious, or impatient? At the end of the week, review your journal. Look for patterns. Do you tend to make impulsive decisions when you feel you are falling behind your peers? Envy? Do you take on too much risk after a period of success? Ego and extrapolation bias? Do you follow the crowd without doing your own thinking? Social proof. This process of self-examination is the first step toward building the emotional discipline that is the hallmark of Buffett's style. Before any major decision, install a mandatory cooling-off period. Never make a significant financial decision under emotional distress. And institutionalize the pre-mortem. For any big commitment, force yourself to write down a 1-page essay titled, "How This Decision Led to My Utter Ruin." This simple exercise can reveal risks that your optimistic brain has conveniently overlooked. The personal resilience audit is not a one-time event. It is a continuous process, a new way of operating in the world. It is the practical, step-by-step method for installing Buffett's anti-ruin operating system into your life. It is the work of building your ark, plank by plank, long before the storm clouds gather. This leads us to the final and most powerful aspect of this entire philosophy: The system we have deconstructed is not merely defensive. It is not about hiding in a bunker and avoiding the world. It is a system of profound, calculated offense. It is a method for building the strength required to seize opportunities that others, in their fragility, are forced to pass up. This is the ultimate mindset shift, the crisis is opportunity mindset. Buffett's entire career can be understood as long periods of patient, disciplined waiting, punctuated by short bursts of decisive, aggressive action. He builds his fortress not to hide from the battle, but to be the last one standing when the smoke clears, ready to claim the spoils. When the tide goes out, and the naked swimmers are exposed, they are forced to sell their most precious assets at fire sale prices to cover their debts. This is the moment Buffett has been preparing for. He is not just liquid, he is psychologically prepared. While the world is gripped by panic and fear, his mind, conditioned by decades of rational practice, is calm and calculating. He feels a surge of excitement, what he calls a greedy feeling, when others are fearful. This is not because he is a predator, but because he recognizes that the greatest opportunities for long-term wealth creation occur when high-quality assets are temporarily mispriced due to short-term fear. His 2008 investments were a masterclass in this principle. When he invested $5 billion in Goldman Sachs, he did so at the peak of the panic. The investment was in the form of preferred stock paying a 10% dividend, an incredible rate at the time. More importantly, he received warrants that gave him the right to buy Goldman Sachs common stock at a fixed price for the next 5 years. This was a deal that was only available because Goldman was desperate for capital and, more importantly, for the Buffett seal of approval to calm the markets. He was able to extract these incredible terms for one reason: he had the cash, and they did not. He was resilient, and they were fragile. The same was true of his investment in Bank of America in 2011, when fears about its mortgage exposure were hammering the stock. He made a single phone call and structured a deal that was, once again, phenomenally advantageous to Berkshire. These were not just financial transactions. They were the culmination of a lifetime of discipline. They were the payoff for decades of scorning leverage, of staying within his circle of certainty, of patiently waiting while others chased fads. Building this mindset in yourself is the final step of the installation. It requires you to rewire your emotional responses to market volatility. Instead of fearing market crashes, you must learn to see them as opportunities. The practical way to do this is to keep a wish list of wonderful companies or assets you would love to own at a much lower price. Research them, understand them, and determine a price at which you would be thrilled to be a buyer. Then, you wait. When the inevitable panic hits and the prices of your chosen assets plummet, you will be psychologically prepared. You will not feel the same fear as everyone else, because this is the moment you have been waiting for. Your fear will be replaced by the calm confidence of a well-prepared plan. You will be able to act rationally and decisively, while others are paralyzed by terror. This is the final evolution. You transform from a potential victim of the tide into the person who profits from its ebb and flow. You have achieved a state of financial invincibility, not because you can predict the future, but because you have built a system that is fundamentally immune to its chaos and designed to capitalize on it. We began this journey with the story of a fallen genius, a swimmer caught naked when the tide of leverage receded with breathtaking speed. We have seen how the very environment of success creates the illusions that lead to such ruin. But we have also deconstructed the blueprint of an alternative, a cognitive operating system built not on the fragile stilts of prediction and leverage, but on the granite bedrock of resilience and rationality. Warren Buffett's fortune is not a monument to his stock-picking prowess. It is a monument to his risk management system. It is a testament to a lifetime spent obsessing not over the upside, but over the avoidance of the downside. He has taught us that true invincibility is not about never being wrong, but about building a system so robust that being wrong doesn't kill you. It is about having the discipline to scorn leverage in a world that worships it, the humility to admit what you don't know, and the patience to wait for the perfect moment to strike. It is about understanding that the path to extraordinary, long-term success is not a straight upward-sloping line. It is a cycle of tides. And the ultimate victory belongs not to the fastest swimmer in the rising water, but to the one who has built a fortress on the shore, ready for the inevitable moment when the tide goes out. This entire framework, this obsession with avoiding ruin to guarantee success, is powered by an even deeper, more fundamental mental model that Warren Buffett applies to every single problem he faces. It's the master algorithm that forces him to think about failure first. Instead of charting a path forward to success, he starts at the end, at total catastrophic failure, and works backward to ensure that path is impossible to tread. This cognitive tool is known as inversion. It is the architectural blueprint for the anti-ruin operating system we've just deconstructed. To truly understand how to build this system in your own mind, you must first master the art of thinking backward. Click the video on your screen now to begin a deep dive into the psychological framework of inversion and learn how Buffett architects systems where losing becomes impossible.